You have $1,000 and you want it to grow instead of vanish on a weekend splurge or a flashy gadget. This is a practical, no-fluff plan you can start today, with clear steps, real-world tips, and a path you can actually implement this week. First, you need a clear goal and a sense of your tolerance for risk, because your choices should hinge on whether you want steady, slower growth or the potential for bigger swings in exchange for higher returns. Spend a few minutes writing down your target, your time horizon, and how you would feel if the market dipped 20% so you can stay disciplined. If you have any high-interest debt, take care of that before you invest, because the interest you're paying can easily drown out gains from most investments. Even a small balance on a credit card can cost you more long-term than the returns you might earn this year, so address it first. Next, split the cash so you're protected and positioned to grow, rather than chasing a single bet. Aim for about $200 in a readily accessible emergency fund in a high-yield savings account, and put the rest into a simple investment plan you can automate. Step 1 of the plan is to buy a broad, low-cost total stock market fund as your core exposure, because it captures almost the entire equity market at a tiny fee, which over time compounds nicely. Think of it as the backbone of your portfolio: wide diversification, minimal turnover, and a fund that you can hold for years without needing to trade. With $1,000, you'll still get broad exposure, even if you start with fractional shares. Step 2 is to add diversification beyond a single fund by including an international stock sleeve and a bond sleeve to temper volatility and smooth out performance across cycles. Even a small allocation to bonds or international equities can reduce drawdowns when U.S. stocks stumble, and it helps you stay the course during rough markets. Step 3 is to use tax-advantaged accounts where you can, because every dollar that grows tax-free or tax-deferred compounds faster than taxable growth. If you are in a country with IRAs, 401ks, or similar vehicles, open one and contribute regularly, even if it's a small amount. Step 4 is how to implement it in practice. Use a low-cost online broker that offers fractional shares and no trading fees, so you can put the full $1,000 to work today, and set up automatic contributions, even if they are small, so you stay invested without relying on willpower. If your broker allows it, consider starting with a simple quarterly rebalance, so your allocations stay aligned with your plan. Keep costs in check by prioritizing funds with the lowest expense ratio and avoiding products that trade frequently or have hidden loads. A simple, well-chosen trio can outperform a collection of flashy funds with higher fees over the long run. Stay focused on the long term. Markets will swing, and headlines will scream, but your best chance at real growth comes from consistent investing and patience. Resist the urge to time the market, and instead, commit to a plan and a cadence you can repeat year after year. Example: allocation with a $1,000 starting point. Put about $600 into a broad total stock market fund, $200 into an international stock fund, and $200 into a short to intermediate-term bond fund. Rebalance annually, or when any sleeve drifts more than 5 percentage points, so the plan stays aligned with your original risk posture. If bonds or international exposure feels scary at first, start with a more conservative split, like 80-20 or 60-40, and adjust as you learn. As you gain experience, tilt toward the target allocation. As you save more later, apply the same framework: low costs, broad diversification, and automatic investing so you're not guessing. Review your plan once a year and keep your expectations realistic about how fast wealth can grow. If you found this helpful, like the video and subscribe for more practical investing guidance. Drop a comment with your first-year goal, your current situation, or any questions you want me to answer.